All right, so let me introduce you to Mr. D. Boykin. Mr. D. Boykin is senior partner at Horn LLP, which is based out of Mississippi. And Horn LLP is one of the top 50 firms in the US. And I had the pleasure of working for Horn for about 8 years, which was about 12 years ago. I left in 2007. I was there since 99. And that's the only job I had other than working at Qatar University as a professional. So I'm a long-term, long-term employee wherever I go. So I'll turn it over to Mr. Boykin, and he's going to continue from here. Go ahead.
Thanks, Shah. Just to give you a little background on myself, I've been with Horn my entire career, so I've been here 33 years. So like Shah, I landed here at Horn right out of college and have been here ever since. Been blessed to be here ever since. What Shah asked me to do today was just kind of review a basic financial statement. Horn is as Shah mentioned, a top 50 CPA firm here in the country, and Horn is a very focus-oriented firm. We have 6 different focus areas. The focus area that I'm a partner in and always have been is what we refer to as our franchise services focus group. And what we do is we provide what we refer to as our recurring services for franchise type businesses. It so happens about 90% of our portfolio is restaurant related, and the lion's share of those are quick service restaurants. So the financial statement we'll be talking through today represents an entity that owns and operates a single Domino's pizza franchise, and that's kind of Domino's is actually the biggest portfolio, the biggest part of our franchise portfolio that we serve. About 60% of our locations are Domino's locations, and we currently serve about 2,500 different franchise locations throughout the country. I think we actually have a franchise client in every state in the U.S. currently. So I guess now I can pull up the document, Shah.
Yeah, you can go to the same place we did the other day. Go to the box, the arrow sticking out on the right side, and then share the PDF file.
It should be uploading now. Can you see it, Shah?
No. I have to click and then share now.
There it is.
It should come. There you go. There it is. Okay, I think we have to individually zoom in. You can zoom in into the financial statements from your machine.
Okay. Is everybody able to see it?
Are you all looking at it? Do you see it? Everybody's seeing it? Yeah. Good.
Awesome. I think it's working. That's good. So what we want to do is just kind of talk through, again, a very basic financial statement that we compile on the income tax basis of accounting. So what I thought we'd do is just kind of walk through each section of the financial statement. And of course, Shah, I'm assuming at some point in time, we'll have time for questions. And I don't know if you want people to ask questions while we're going through it or save it toward the end, however you want to do it.
Right. So you can, I think it's best to ask the questions as you go through, because they may have a gap in understanding as you go forward. So.
Got it. So page 1 is the page 1 of the balance sheet. Again, pretty simple. You'll notice that under the current asset section, basically that entails everything that's either cash or, the way I think of it, things that are readily convertible to cash in short notice if need be. One thing you will notice here is you'll see several accounts receivable lines that are marked through are blacked out. That's because the owners of this single store entity also own other entities, and that's just where they loan money back and forth across the entities, usually around where one entity is paying bills on behalf of another. So basically, outside of that, again, you can see it's pretty simple. They have their cash in their bank accounts. They have their food and beverage inventories. And then, of course, they have prepaid, uh, typically prepaids related to insurance, and where they pay the next month's rent, if you will, ahead of time. The next section, obviously, is the property, plant, and equipment. And again, the only thing that I would mention here is that this store has been in existence for quite some time, and you'll see that basically there's very little book value of the fixed assets because they've been fully depreciated almost. But this does give you some quick information about, from the inception of the store being opened, what has been invested in the business by way of fixed assets. And you'll notice in this Domino's, and is the case in most of our restaurant locations, not all, but most, you will see that they typically operate these restaurants in a leasehold situation where the operating entity is not the owner of any real estate. They're just going in and putting in the equipment and building out leasehold improvements, and again, not owning any actual building or land inside the operating entity, just as this one does not. Any questions on the first page of the balance sheet so far?
This is a repurchase. The franchise fee is low, yeah?
Yeah, again, in this particular brand, the technical franchise fee today, and again, this store it has been around for several years, but today the Domino's brand franchise fee is very low on the spectrum of, if you compare it to other franchises out there. But also another very, very unique distinction with the Domino's brand is, in order to become a franchisee, you have to have a certain tenure working at certain levels inside the franchise Domino's brand. So therefore, it's a little different situation, meaning, I could have all the money in the world and I can't go buy Domino's Pizza franchise today and be a 51% or more owner because I'm not, quote unquote, qualified, because I have not come up through the system and held those particular operational roles in the system. So we refer to it as a closed system from a franchise standpoint, which again, it's not the only major franchise that operates that way, but it is quite unique in the franchise marketplace. The next page of I keep referring to it as the balance sheet. As you guys know, the technical name is the statement of assets, liabilities, and members' equity, because it's income tax basis. But page 2 shows you the liabilities, both current and long-term liabilities, and of course, current liabilities being things that should be expected to be paid within the next normal operating cycle. Again, typically, in this particular brand, you get 2 weeks float on your food purchases, and of course, you have your accrued payroll. And again, typically they're paying on a bi-weekly basis. So there's usually two weeks of payroll outstanding as being due at the end of any particular period. And I did want to mention this too. One thing, when we get to the P&L, profit and loss statement next, you'll notice that these financial statements are kept on what we refer to as a period basis instead of a monthly basis. And that's very common in the restaurant industry, whereby your accounting cycles or your accounting periods in Domino's are 13 4-week periods. And you may ask, well, why would they do that instead of keeping their books on a monthly basis? If you think about it, it's simply because, from a comparability standpoint, as an operator and judging the results of your operations, everything in a restaurant is absolutely driven by the days of the week. So if you were trying to compare the month of May to the month of April, the month of May very well could have 5 weekends in it, and the month of April have 4. So from a restaurant business standpoint, because so much of the revenue and the business that they do is more heavily weighted to the weekend, it just really clouds it and makes a monthly reporting a lot less useful from a business decision-making standpoint. So that's why you'll see these financials, and a lot of restaurant financials are kept on a period basis instead of a monthly basis. With that being said, back to the liability side of the financial statement, you will see in the long-term liabilities something that's very unique to the year 2020 for a lot of our clients and for a lot of businesses in the United States this year. You'll see a notes payable for the SBA, that's the Small Business Administration. And back in April, after COVID came about, there was an act signed into law whereby businesses could apply for a loan through the SBA, which was termed the Paycheck Protection Program, whereby you could basically calculate your loan amount using the prior 10 weeks of payroll cost and some other costs related to payroll costs, and you could apply for these loans through the SBA. And the better part about that program is that if over a certain covered period of time after you received your loan proceeds, if you can document that you spent at least that much money for keeping people employed, meaning wages and other related expenses related to employment, then you can then apply, which we're in the process of doing now with an awful lot of clients. You can apply for this loan to be 100% forgiven based upon, did you meet the criteria of how did you employ that money that you borrowed. So in this particular entity's case, they secured $112,400 through the Paycheck Protection Program, and something that we'll get into with when we start looking at the profit and loss statement. Domino's Pizza being a delivery concept first and foremost, with the pandemic, and with consumer approaches to how they were eating and how they were obtaining food from restaurants. Obviously, all of our delivery businesses, such as Domino's, they have seen an actual huge increase in business, which we will see when we start looking at their profit and loss results. And so I say that to say that on our Domino's brand, pretty much everyone, if not everyone, have done so much more business. The issue of being able to document that they use their loan proceeds for qualified wage-related expenses is not an issue. So just like this particular one-store entity, when the process is completed, we are in anticipation that entire $112,400 will be a forgiven loan, and they will not be required to repay any of it. So it's going to be a really, really financial windfall for those businesses that were qualified to borrow the money and certainly didn't really have an economic injury from the pandemic, which was not a requirement of applying for the loan. So they're really doing more business than ever, and they're going to get some of the SBA, or in this case, most of the SBA loan proceeds forgiven. And then, of course, you'll see the members' equity account. This particular one-store entity is owned by 2 individuals, and we keep individual capital and draw accounts on the face of the balance sheet for each owner. I'm going to pause here, Shaw, and see if anybody has any questions at this point.
Any questions? Indeed, the ownership is proportionate to the capital invested shown.
Yes, that's right.
And they really didn't have any loan before this
No,
SBA loan.
the entity was debt free prior to the Paycheck Protection Loan. And again, you'll see that this store is even in prior year before COVID, it was a very it was certainly on the strong side as far as a Domino's Pizza location, and it's been around a while, Shaw. So they long ago retired the debt that they incurred to originally build out the store.
So the store is hosting very well.
Right. So with no questions here, I'll move on to the first page of the statement of revenue and expenses, which you'll hear me refer to as the profit and loss statement many times.
So income statement is the textbook name.
Yep. So you'll see that we present these financial statements where we show the current 4-week period, and we always compare it to the exact same 4-week period of the prior year. Again, none of that's required, obviously, from a reporting standpoint. We just think it provides a lot of information from an operational result standpoint to give the owner and operators of the actual restaurant information from which to make business decisions. One thing I did want to point out is if you look over in the horizontally to the right, you'll see the current year to date, which in this case, it's 7 4-week periods. So we're talking about 28 weeks of business here. And you will see that this year, through 7 periods, the store had generated royalty sales, meaning the total volume they had done in sales was almost $1.29 million compared to the same 7 periods of the prior year, $1.057 million.
This
And
is
as
the
a
royalty sales line. The royalty sales line, yes.
royalty sales.
Royalty sales. And also, I mean, if you just look at the delivery, just for this month compared to this month last year, or this period compared to last year, this period, it's 25% increase. 125, it was 100,000. Tremendous increase.
And if you look at year to date total sales, it's about 22% income. I mean, a 22% increase.
Yeah, 23 almost.
Yep. And one thing that I will tell you that is very comparable to what the entire brand looks like for 2020 compared to 2019. And again, that's what I call the COVID effect of what's going on with these delivery-based businesses. Next.
We have a question? Okay, we have a question. Go ahead. Your speaker is not. Okay, there it is.
Doctor, I would like to know the difference between you have the period end and although you have mentioned the same, how are they different in this case?
I couldn't quite hear the question, Shaw. Did you?
Repeat the question.
You have the period end over here, which is I would like to know the difference between what is the difference period ending and the year to date.
Yes, okay. The period ending is the most recent 4 weeks of operation, which in this case, the current year is the 4 weeks that ended on July the 12th, 2020, compared to the similar 4 weeks of last year, meaning this same period last year ended on July 14th. If you look at the year-to-date column, since it's 7 4-week periods that we're looking at, in the year-to-date column 2020, that's 28 weeks of operation results in 2020 compared to the side-by-side column. It's the same, 28 weeks of 2019 from a comparability standpoint.
Is that clear?
Okay. Yes.
And then also on page 1 of the income statement, you will see we highlight the cost of food sales which is the cost of goods sold as you might think about it, and then of course what we refer to as the total wages. And the reason that we subtotal these is that in this particular industry, in the restaurant industry, from a controllable cost standpoint, these are the two costs that basically determines if your restaurant is successful or not successful from a financial statement standpoint. Meaning, as far as you'll hear them referred to as prime cost in the restaurant industry, but basically the controllable, the food cost, and the controllable of your labor cost, how you manage that basically determines the overall outcome of your result of the restaurant operation. So that's why these highlight and subtotal that accordingly.
I have one more question. I have one more question. Go ahead, D.
Okay. And then the next page, again, this is not anything that's required. This is the way that we lay out the financial statement, because again, the service that we provide our clients is not just compiling the financial statement, but then taking the financial statement information that we're compiling every period and making sure that we're sharing insights with our clients. Because of the fact that currently we serve 1,400 Domino's locations, we format our financial statements to make it easier to see things that we can talk to the client about if we see opportunities or threats within a particular store. So you'll see the next section being the advertising expense, and you'll see national advertising and direct advertising, and then advertising related to recruiting employees. And one thing I wanted to mention there, if you'll notice, the advertising dash national, that is a fee at 6% of sales that is paid to the franchisor, which is Domino's Pizza. And in any franchise concept, that's very common, meaning typically any franchise concept, the franchisor will charge each location two things based on a percentage of sales usually, and that is a national advertising fee, and also something that you'll see on the next page, which is a royalty fee. In Domino's Pizza currently, the national advertising fee is 6% of sales, and you'll see on the next page that the royalty fee represents 5.5% of sales.
So D, if I can say something, add something to this to bring this home a little bit, because we have Domino's Pizzas here, we have McDonald's and all the brands, big brands here. So the national advertising is for the advertisement that you see in the billboards that is advertised for all stores. So it's not any store specific, it's advertised by the franchisor. So you stop at the signal light and there's an ad for McDonald's. It's done by McDonald's franchisor, right?
That's
not
right.
by individual stores. And this is the money that the individual stores pay the franchisor, the main company, to advertise. And the advertising direct is the individual store doing advertising, right? Locally, sending coupons or whatever they're doing to individual homes and so forth around the location that this store is located at. So that's direct advertising, which they do themselves.
That's right.
Is that right?
And that's exactly right. Now, one thing you'll notice here is inside this company, the owner of the franchise, quote unquote, charges the store this 3% as a percentage of sales, whether they spend it or not. And you'll see another cost center that we'll look at, which is the administrative cost center inside this entity. And you'll see a credit coming back to the administrative cost center because they're actually not spending the full 3% locally. And we'll talk about that later. But yes, you're absolutely right, Shaw. The advertising direct is representative of the non-national advertising expense being incurred at the local store level. The next section is just all the costs around the drivers, meaning obviously Domino's being a delivery business, they have an awful lot of drivers that work for them, and the drivers are paid a mileage reimbursement at the end of each day. and that's what that section represents, along with some
their
other
gas.
actual vehicle-related expenses. And then we typically also subcategorize anything to do with location expense, which is where basically their utilities and their rent, and of course their insurance cost related to the physical location. And again, there's some theory behind why we group these things, and basically it's to allow us and allow the client to be more easily compare one operating store to another, to see where there's opportunities or threats from because obviously if you can line up 10 stores across and look at them side by side, it's by these categorizations that we do, it makes it much easier to identify things that are out of norm. It could be ways to improve the overall result of the store.
Now, Dee, could you go back to the previous page? I just want you to can you give them the industry averages for these categories, the cost of goods sold, the labor?
Yeah, and I think it's real interesting that it may vary between brand or even concept, Shaw, as it relates to a restaurant, but typically the food and the labor, whether we were talking about a fine dining restaurant or whether we're talking about a quick service restaurant, typically what you will find is, whereas in fine dining the food cost percentage may be closer to 40%, the labor is going to be closer to 15 to 20. Whereas in a quick service, whether that's McDonald's, Domino's, Popeyes, things like that, it's going to be closer between 30 and 35% on the food side, and somewhere around 20 to 25% on the labor side. But again, in the restaurant industry, which would not apply to manufacturing or other types of businesses, typically those two prime costs are going to be, regardless of the concept or brand you look at, the average is going to be somewhere between 50 and 60%.
Okay, so now the food cost between 30 and 35, and labor cost in the neighborhood of 25, including taxes, yeah?
Yes, that's right.
Okay. So then let's go to the next page and give us the industry average as well for the advertising.
Well, one thing that's really we have seen a shift over the years. You see this 9% that's reflected on the store level, which is 6% national and 3% a local advertising charge, again, that the franchisee is charging the store. I already mentioned he's really not spending that whole 3%. Used to, when I say used to, a decade ago, I would have told you the average actual spend between those two categories was somewhere between 8 and 10% of sales. Now, a decade ago, the franchisor charge was half what it is now. It was 3%. And then they would spend another 5 to 7% locally advertising their particular restaurant. So as the franchisor raised the franchisor charge, it provided the franchisor a lot more funds to go buy TV, mainly here in the U.S. They have a lot more money, so they can be a lot more effective with their TV spend. And because of the effectiveness of that dollar, because all the stores are contributing to the big pool, that's why you can, if you turned on the NFL game on Sunday, Domino's Pizza is, the main sponsor of the entire NFL or NBA or whatever it is. It's because of the commingling of all those dollars. It made them be a lot more effective with that 6% than they used to be able to be when they were only contributing 3% to the national ad campaign and trying to do the rest of it locally. So today, as we'll see when we get to the combined company, the actual spend here on this company is going to be probably definitely less than 8%, if not less than 7% in total, meaning they're not spending a lot locally anymore. They're basically relying on the national ad money that they spend to actually take care of all their advertising.
Give us the industry average on the rent first and then the location.
Yeah, typically in quick service, and again, quick service being different than, a fine dining location. Quick service rent is typically going to run somewhere between 1 and 3%. You'll see that this store is even less than that. But I did want to mention this store is in a relatively rural area in North Mississippi, where rents are really cheap, and they benefit from that. But when we look across our 1,400 stores of Domino's Pizza, the average rent in this brand is somewhere between 2 and 3% of sales.
Oh, wow, that's low.
And total locations cost is usually running somewhere between 6 and 8%. And again, this store being where it's at benefits greatly. I mean, its utilities are a little lower, and obviously its rent's a lot lower. And the payroll and the property taxes are a lot lower than it might be, let's say, if it was in Boston, as an example.
No, of course.
Okay. Then the next page is the last page of the income statement, where we kind of lump in everything that we refer to as general expenses. One things I wanted to point out here that are very important when you're trying to judge how's the store really performing. If you'll notice, the second expense item says administrative fee. You'll see it's set at 6% of sales. Well, keep in mind, and I'll show you this on the administrative cost center P&L or income statement here in a second. That is an internally charged fee where the franchisor, quote unquote, the franchisee, the owner, charges this store 6% of sales. And the theory behind that is oftentimes they are rewarding the manager of the store based upon the store bottom line result. So the theory behind charging the 6% administrative fee is to cover overhead type items, reinvestments into the business, debt service on stores that have debt service. So it's an internal charge, and I'll show you where that comes back in the admin company income statement as a credit here in a minute, but it's not a real expense that the store is incurring. And that's important when you start talking about, what's this store worth? How's it performing from an overall return on investment standpoint? And again, you'll see some other miscellaneous income items at the bottom, and we typically highlight what we're paying the manager. Again, just from a comparability standpoint, again, that's something because typically the manager's bonuses is something that is some, you can gain some insights as far as comparing what am I paying out in manager bonuses compared to my peer group or compared to other stores that I have. So at the end of the day, you see through 7 periods, which is 28 weeks, even after these internal charges of advertising direct and the admin fee, you can see that this store is showing a $96,520 bottom line profit through the 7 periods compared to last year being $61,000. And if you think about it, the way I think about it is, if you went back to page 1 of the income statement, we talked about how sales were 22% up. Well, that 22% is over $230,000 difference between last year and this year. If you think about the concept between variable cost and fixed cost, a restaurant's typically going to have a contribution margin of somewhere between 20 and 25%. So you would expect the actual cash flow being generated by the store to be 20-25% more of whatever my incremental sale increase was. So, you can do that math, and it's pretty close to that number. Meaning for every additional dollar, for every additional incremental dollar of sales, I should be throwing off 20 to 25 cents on that dollar to the bottom line because I've covered my fixed cost, and I just have to cover my variable cost on each incremental dollar.
So this the year-to-date 2020 operating profit is 116,000, which is 9%. It's actually double that if you take the 6% admin and the 3% advertisement that you're taking, right?
That's right. That's right.
Double that in reality.
Yep. And we'll talk through that in a minute. Yeah, I mean, you could take the 96,000 for this year, Shah, and add back 77,000, I mean, you can see where you're getting to, you know, between 15 and 20% sales is what the store is really generating in true store level cash flow.
Where is depreciation?
Over on the admin company.
Okay.
And again, we'll look at that next. Like I told you, in addition to the store level income statement, this particular owner has an administrative income statement too, where it actually reflects some things that are for above store supervision. Meaning, if you'll look, there's some supervisor wages because this particular owner owns multiple stores across multiple entities. They have an allocation of supervisors costs that they put to this store, and as well as some clerical help that works for the overall conglomerate. So they try to spread those costs out. And again, it really has nothing to do with the operation of what goes on inside the store. So they do it through this administrative company cost center. But a biggie I wanted to point out, remember we talked about that 3% charge for advertising direct. Well, if you look around the middle of the page here, you'll see advertising direct with a credit of $38,492 in the year-to-date column. That just tells you that they've charged that store 3%. That 3% is $38,492 more than the entity has actually incurred for advertising direct or local marketing.
So these percentages of this supervisor's salary, they're calculated off of what number, D?
Well, on the admin company, they were the 24 and the 75 is just to show you the split between the two categories. But since there's no sales on the admin company, that's why you see 0 percentages.
Yes.
So I just wanted to show you how that credit came back. And if you'll look on the next page, you'll see under that second line under general expenses, you see the credit for that admin fee that was charged to the store, which is a credit back on the administrative cost center. And all that to say, if you go to the next page, it is the consolidated company, and that's everything put together as an income statement. And so when you got, if for instance, if you looked at administrative fee, there will be no expense because it was totally internal, charged to the store, picked up as a credit on the administrative cost center. So there is no admin fee as a true expense. And then if you looked on page 2, you can see what did they actually spend in advertising direct. Remember, they charged the store 3%, and they basically spent nothing. They're completely relying on the national advertising spend to cover all of their advertising that they're doing, and that is not uncommon in the Domino's brand today.
But the pizza customers are loyal as well, right? So they're loyal.
Right.
So
another just an interesting point, and it's not the same with every brand, but in the Domino's brand, of every sale that they make to a customer, of every sale that they make, about 65 to 70% of every transaction, the price of that transaction is determined from a national advertising campaign. Meaning every store can set the price for its, 14-inch pizza. But the national advertising that you see on the TV and the radio and the billboards, 65 to 70% of every order placed is placed based on one of those ads. So the price is really being set by the franchisor through the advertising campaign that they're running.
And the franchisee must honor that, right? They don't have a choice but to honor the advertisement.
That is correct.
And do they accept competitors' coupons as well?
I think that is more up to the individual franchisee's decision, but I will say most do.
So what that is Pizza Hut says buy one get one free, and somebody brings that coupon to Domino's, most stores accept that as well. So any competitor
typically yes, because they want to make sure that they keep that customer or make that customer become a customer of theirs.
Right. So competitors' coupons or competitors offer any other pizza store that has an offer, they can bring that to Domino's. Most stores will honor that.
Most stores will honor it. Again, that decision is up to the franchisee, but most of them would honor that.
Right, which is a great decision, which is a great business.
So if you get to the last page of the consolidated company, to your point, Shah, about the admin fee, when you cancel out that admin fee, you will see that year to date this year, this one store has a net bottom line profit of $182,000 through 7 periods, 28 weeks, compared to the prior year at the same time, $164,000. And the one thing I did want to point out, if you'll notice in this year, if you start at the 182 and you go up 2 lines, you'll see an expense called re-image expense, $45,000. Well, that is where they have done some capital improvements inside the store during 2020 that are expensable from an income tax standpoint, but it's absolutely extraordinary. So if you said, hey, Dee, compare this year to last year, I would really think of adding back that $45,000 expense. So then you would be comparing, if you added $45,000 to the 182, you can see what the store is really doing by way of a comparison to last year.
227, which is about 70, close to 60 some thousand more in 7 periods.
Again, think about what I said originally about the contribution margin. The store's done $232,000 more in royalty sales. 60% of that is going to be about 30%, which is what you would expect in a restaurant operation.
Sweet.
And then we'll go to the last page of the standard financial statement that we issue. And that is the statement of cash flows. And Shah can tell you back in the days when he and I worked together, I always said this to him, and that is, from an advisor standpoint or just assessing how a business is doing, if out of all these pages in the financial statement, you said you can only use one, you can only see one page. If I had to pick one page to tell how the business is doing, it would be this page. And the reason I say that is because it starts with the bottom line of the income statement. So I get that information off of this page. Then more importantly, I think it shows, okay, from what the bottom line net income is, what has happened to those results during the current period or the year to date period of time.
Now, Dee, I made a statement to the class earlier, and I need you to either validate or invalidate it. I said to them that, many accountants or students graduate with an accounting degree and come, and they really don't have a good idea of how the statement of cash flow works or how to read it. Is that a valid
Absolutely. 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 No doubt it is. And if you want to take that comment and apply it to bankers, it would be 110% of them don't understand it, it seems like. But I think it's a wealth of knowledge because, at the end of the way, typically a lot of businesses, not so much this one, but a lot of businesses obviously have some leverage aspect to them where they have debt. So as y'all know, when you're retiring your debt principal, it's not a deduction, it's not an expense anywhere on your income statement. But it's certainly a requirement or a need that the business needs to be able to, it's an obligation that the business needs to meet typically every month because your debt service payment is usually on a monthly basis. There's also, every business has some capital reinvestment requirement, whether that be my oven goes out every 10 years or my make line I may have to replace a make line every 5 years, or my computer POS system, I have monitors that go out every 90 days or whatever. There's a certain amount of capital reinvestment that's also required. This typically not necessarily shows up on your income statement every period or every month. So the reason I say if I could have one page to assess how the business is doing, I really like this statement of cash flows, because again, I can say from an income statement standpoint, I have net income of $182,000 year to date this year. Well, the next section, oh yeah, and it tells me how much of that was depreciation and amortization. If you see in this case, it's only $368, and that's because everything's so fully depreciated because the store has been around a while. So then you get that next section of the operating section of the statement of cash flows, and that is the part that I don't pay a lot of attention to when I'm really assessing how's the business doing, because a lot of those pluses and minuses from a cash position standpoint, I deem to be discretionary decisions made by the owner. As an example, I can choose to increase the inventories in my store this week, meaning order more cheese and put it in my cooler. Well, it's going to cost me some cash flow to do that. But does that mean that I'm doing any better or worse? I say no. It's just a discretionary decision I made. Same thing is I can choose to not pay all my bills this week that are due. Well, my cash in the bank's going to go up. But does that have any bearing on how my business is really performing? I say no, because eventually those bills have to be paid. So I don't pay a lot of attention when I'm assessing. If I could only have this one page, I don't pay a lot of attention to the operating section, but I do focus on, okay, I've generated $182,000 roughly year to date. I've reinvested that next section of cash flows from investing activities. I've reinvested $14,000 of that in fixed assets. I spent $2,600, almost $2,700 on computer and phone equipment, and another almost north of $11,000 on other equipment items that I've had to place in service in my store during this year to date. Then I look at the next section and say that $112,400, which is a plus to my cash flow. We know what that is based on the prior conversation, and that is the money that I borrowed through the SBA program that became available to them.
Right.
Now, you'll see some principal payments on debt in the year-to-date column of $16,820. None in the current period. If you remember when we looked at the balance sheet, there was no other debt. That just means coming into the year, they actually had a debt of $16,820, and they retired that debt completely during this year to date. But it was a use of money. It was a use of the $182, or part of the $182,000 that the store generated. And then, of course, another very useful piece of information is the next or last line on the statement of cash flow, which says withdrawals. And that's what the owners have taken out of the business in the form of a draw, not in the form of wages, but in the form of a distribution of profits.
To compare that with a public company, this is like a dividend, right?
Dividend, exactly. Yep.
Right. The drawing is like a dividend, which we are studying in the book as a dividend, which is paid to the owners. In this case, it's called withdrawals, because these are closely held companies. There are only two owners, so they take whatever they take as they like.
Right. Right. And if there's no questions on the statement of cash flow, I wanted to talk briefly, Shaw, about valuation.
Right. Can we go to the balance sheet? Can we go to the balance sheet?
Yep, absolutely.
First page. Okay, so to start this discussion, you see what they're going to sell is if another owner comes in and they leave, obviously they're going to take all their cash and all their current assets. There will be nothing left. They will be left with, the new owners are going to be left with this fixed assets, which is book value of it is $28,346.
Mm-hmm.
Right? So this is what the book value of the assets are when the owners walk out and the new owners come in. They leave about plus minus 28,000 worth of assets, so to say.
Right.
So can we pay 28,000 and get this store, or how
No
does
way.
that work?
No way. And typically, at least in these type businesses, typically if you own this store, this one store in this entity, I would come to you as a potential buyer, and I would make you an offer to buy your assets, meaning I wouldn't be buying your ownership in this entity. I would just say, your cash, your receivables, to your point, your prepaids, all that's you. I just want to come buy the store from you. And when I make my offer, I'm gonna base that offer based upon, um, what required return am I going to expect as a buyer of this asset? And so what's going to come into play there? It's, to me, what is this asset, meaning this Domino's Pizza trade name location? What is it producing by way of cash flow? What can I expect it to produce by way of cash flow? And I can determine what would I be willing to pay based upon the return on my investment that I would require.
So where do we go to look at that number?
Well, first of all, we go and say, what's it producing, right? So you would go back to that $182,000 year-to-date number.
Take us on the screen. Take us there. Take
Yep.
us where we need
Yep.
to go.
So you would go right back here and say, okay, again, this is just 28 weeks of a full year. So through
Right.
28,
Let's say it's half.
that's half, roughly half, that's right. So through half of a year, it's produced $182,207 bottom line. But remember this re-image cost, which is really capital investment, which has nothing to do, meaning after that capital investment's made, you're not going to incur that expense tomorrow if I became the owner of it tomorrow. So I would add that back and say that now I'm at 227, okay? And then I would say, is there any depreciation or amortization, meaning non-cash expenses been deducted? And if you remember, it was a very minor amount.
100 something.
Yeah. So I'm going to say that's irrelative. So through half of a year, I'm going to say this store, this Domino's Pizza trade name location has produced 200, I'm just going to use a round number and say $225,000. And that's for half of a year. So again, based on just this year, if you annualized it, you'd double that, and you'd say you could make an educated guess that in 2020, the store is going to throw off $550,000 of cash flow. With me?
Yeah.
Now, if as I'm consulting people in buying and selling stores today, I'm probably not making my decisions based upon just the 2020 results. And the reason being is because certainly COVID has affected this thing in a very positive way, especially if I'm buying stores. I'm not sure I want to buy them based on expecting the future to look as good as 2020. So I may look at, the prior year as well and get some blend of that to determine what would I expect this store to produce in cash flow. And then I'm going to make my decision based upon, what would I pay for that? And the way I like to think about it, Shaw, is that restaurants are cash flow businesses, meaning, I mentioned about going and buying a new oven tomorrow. Well, if we needed to replace the oven for this restaurant tomorrow, that oven would cost $40,000 brand new. Well, 2 days after you used it, if you closed the restaurant and you said, I've got this used oven for sale, you could probably get $25,000 for it because now it's a used oven. But again, it's a cash flow business. That oven has very little to do with what value the business. It's what cash flow is this business generating. And then to determine what it's worth, obviously, you as the investor, meaning the buyer of the business, you would have to ask yourself, what type of rate of return would I be willing to accept for the risk that I'm going to take to buy this business? So, whatever that is. But in a restaurant business, obviously restaurants are very risky by nature. A non-franchise restaurant investment is a lot more risky than a franchise restaurant business because of the name brand, the support that you have from the franchisor. But just a well-known fact is that restaurants in general, 75% of all restaurants that open fail within 90 days in the U.S. That's a pretty daunting average. But again, that's all restaurants. A lot of people, open restaurants. The number one reason that restaurants fail is because they're undercapitalized when they open, meaning people put together all the money, all they can borrow, all they have to open a restaurant, and if it doesn't do well from the beginning, they usually don't have the financial wherewithal to survive long enough to get it to where it might do enough business to make it. So all that being said, it's a risky business. So, I try to advise our clients when we're going to buy restaurants to look at it strictly from, first and foremost, what risk am I taking and what return on that investment should I be expecting to determine what would I be willing to pay for it. And as y'all know, you have everybody who has money to invest has different options of how to invest it. And you could go put money in a certificate of deposit maybe and get, at least today, here where I'm at, you might get 1% return on your money if you're lucky, but it's probably, it's very low risk. But if you start going and investing in restaurants, whether they're franchise or otherwise, you'd have to look at, how long has the restaurant been opening? Are these results, is there a good history here of strong financial results? Are there any things coming in the future that should make me think of things that may make this decline substantially? So all those factors, but at the end of the day, you have to get comfortable with what you would think the investment would generate, and then determine, should I require a 20% annual return on my investment because of the risk involved here? If I'm okay with a 20% return on my investment, then I could take what I would expect it to generate, right? Multiply it times 5. That would tell me what it's worth.
So let's say, after doing the math and so forth, a store has 200,000 in cash flow, right?
Mm-hmm.
With let's say 5 years of history, $200,000 in cash flow, annual cash flow with 5 years of history. So if I were to be happy with 20%, then I would give $1 million for that store, right?
That's right. That's right.
That would be $1 million for the store. Again, many factors: sales trend, upwards or downwards,
Right.
And then
Yeah, and another piece that comes into play sometimes from a buyer perspective is, you have to make sure that, depending upon your availability of funds, meaning if I'm going to have to borrow the money buy the store, then I can only pay enough. I can only pay as much as the store can service the debt to pay for it. So sometimes the financing situation can have an effect on what the buyer might be willing and able to offer for something that they're buying as well.
All right. We have the Dean of the College of Business, as well as the Department Head of the Department of Accounting, who have joined. This is about 8 o'clock in the evening, and they have joined to listen to your talk. So if they're listening, I would like them to say something to Mr. Boykin.
Assalamu alaikum.
Dr. Adam, this is Dr. Adam D. This is Alaikum Assalam. This is Dr. Adam. He is the Dean of the College of Business D.
Hello there.
D, very nice meeting you, and we really appreciate your contribution to our students. This is a wonderful exposure. Actually, I am not an accounting person, but I enjoyed the presentation, and I consider it as a real. Actually, I'm sure Shah, presents a lot of textbook cases, but this is a real thing, and it is very wonderful for our students to see that. And coming from someone with 30 plus years who looks much younger than that, but
Well, thank you. You're too kind.
that's a wealth of experience for sure. So we really appreciate it, and thank you indeed.
Yes, you bet. I enjoyed it.
Thank you.
Dr. Mustafa, would you like to say something? Dr. Mustafa, are you there? I think he's like my undergraduate students who logs in and just, oh, here he is.
Hello, Sharayar. How are you?
Good, good. Welcome. Assalamu alaikum. Indeed, this is our...
Walaikum salam wa barakatuh. It was very nice exposure today that I listened to this real life case from your ex line manager, I would say, at the time. So presenting the financial statement in such a way to our students, I think you're gonna raise their own view about the cases that they do in the class. And very much thanks, Dee, for having you today. I'm sure the time difference is very huge between Qatar and where are you now.
It is.
Thanks very much for taking the burden and the time to do the class for our students. This is much appreciated, actually.
I enjoyed it. Thank you.
Dr. Adam and Dr. Mustafa, thank you so much for joining at this late hour. I know you have better things to do, but we really appreciate you joining us. It gives our presentation significance. Really appreciate it.
Thank you for inviting me.
Thanks for coming. Are there any questions from anyone regarding anything that Mr. Boykin has addressed? Now he has been kind enough to share his email address with you, so you can listen to this video and you can email him if you have further questions until the end of the semester, until we do the final project. So I know you're overwhelmed because it's a lot of information, but you can listen to the video again and, you know, stop and make more notes. I know you've been making notes. I have seen you making notes, and I know it's very, very beneficial to hear from someone who's in the industry. You know, I talk about the things that I did before and present to you what I have done before, but something that is contemporary, like this COVID-19 and the loan that the company got and the sales trend because of the COVID-19. And generally, I would have thought that restaurant businesses suffered, but it's not the case with the delivery businesses at all. It's quite the contrary. So this is really an eye-opening. So any questions? I think there are no questions at the present. You know, don't be surprised if you get a
Absolutely.
wave of
Shoot.
questions.
Ask me anything you want. I'll certainly respond.
We want to thank you, Dee, very much for your time and this excellent presentation. This is everything that I expected and more. And good to see you again.
You bet, brother.
And we should see each other more, like we did last Sunday or Saturday.
That's right. Well, listen, Shah, take care. And you guys listen to Shah. He will only direct you in the right way. I know that. He's a great man.
Thank you, Dee.
See you, man.
Right. Bye.
Thank you. Thank you, Dee.
Thank you.